Hello everyone, welcome back to Pension Why. Let me ask you a question. Have you ever checked your age pension assessment and wondered why Centrelink seems to focus on your assets, even though your income is quite low? Or maybe you've had the opposite experience. You don't own many assets, yet Centrelink seems more interested in your income. It can feel confusing. Today we're going to unpack something many people don't realize when they first apply for the age pension. Centrelink actually looks at two different financial measurements before deciding how much pension someone can receive. Understanding how this works can make a big difference when you're planning your retirement or filling out pension forms. So let's walk through it together. When Centrelink assesses someone for the age pension, they don't rely on just one method. Instead, they apply two separate assessments. One looks at income, and the other looks at assets. Each of these assessments produces its own pension result. Once both calculations are done, Centrelink compares them. The final pension rate is based on the assessment that produces the smaller entitlement. In other words, whichever calculation results in the lower payment becomes the one that determines the pension rate. This approach is written into the rules that govern how the age pension system operates. The first assessment focuses on income. This includes money that comes in regularly, such as wages from employment, deemed income, rental income from property, payments from certain superannuation income streams. For financial investments like bank accounts, shares, managed investment, or accumulation phase, Centrelink usually applies something called deaning. The idea behind the income assessment is fairly straightforward. If someone has a higher level of income, their reliance on the age pension may be lower. But income is only one part of the picture. The second assessment looks at assets. Assets represent the things someone owns that have financial value. Examples include money in bank accounts, superannuation once a person reaches pension age, shares and managed investments, investment properties, other valuable financial holdings. The asset assessment considers whether someone has access to resources that could support their living expenses. Even if those assets are not producing much income, they may still influence the pension calculation. One way to picture this system is to imagine two different lenses. One lens focuses on money coming in. The other lens focuses on wealth that someone owns. Centrelink reviews both perspectives. Whichever perspective suggests a smaller pension amount becomes the one that determines the outcome. This structure helps ensure that both income and accumulated wealth are considered when determining eligibility. Let's look at a simple example. Imagine someone who is retired and no longer works. Their regular income is very low, so under the income assessment they may qualify for a relatively high pension rate. However, if that same person has a significant amount saved in investments or superannuation, the asset assessment may produce a different result. Because the asset assessment might lead to a lower pension amount, that calculation becomes the one used for the final payment. This is why some retirees are surprised when their pension is influenced by assets, even though their income appears modest. The age pension is designed to act as a support system for retirement, rather than the sole source of income for everyone. To make the system consistent, the rules consider both income available now, financial resources accumulated over time. By looking at both factors, the system aims to create a balanced approach when determining pension entitlements. Understanding this structure can help explain why pension outcomes sometimes change. For example, certain life events can shift the balance between the two assessments. Things like accessing superannuation, selling a property, changes in investment balances. These situations can alter how the income or asset calculations apply. Knowing that both assessments exist helps make those outcomes easier to understand. If today's explanation helped clarify how the age pension assessment works, feel free to subscribe to Pension Why. This channel is all about breaking down complicated pension questions into clear and practical explanations. And if there's a particular pension topic you'd like explored in a future video, leave it in the comments. Thanks for watching, and I'll see you in the next Pension Why video. Stay informed, stay empowered.